Pick the wrong platform to buy your first ETF and you'll pay over $600 more in brokerage over 10 years for the exact same investment. Pick the wrong fund and a tiny fee difference quietly costs you $11,000 over 20 years. I've compared every major ETF and every platform in Australia so you can skip the spreadsheet and just get started. ETFs have become the default way Australians invest outside of super. The industry hit $330.6 billion at the end of 2025, up over 34% in a single year. Betashares expects it to pass $400 billion sometime this year. There are now over 450 products on the ASX, but as a beginner, you only need to care about a handful and you need to make 3 decisions to get this right. Most beginners spend all their energy picking the perfect ETF and 0 minutes thinking about tax or brokerage. Those 2 things will save or cost you more than any fund choice ever will. So we're going to cover all 3, what to buy, where to buy it, and the tax rules that actually put money back in your pocket. By the end, I'll tell you exactly what I'd pick if I were starting from 0 today. First, what even is an ETF? It's a managed fund that trades on the stock exchange. Just like a regular share. You buy units in it and the fund owns the actual shares underneath. Most ETFs in Australia are passive, they just track an index rather than trying to beat the market. That's what makes them so cheap. And right now, cheap is an understatement. There's a genuine fee war happening between the big providers and beginners are the winners. The cheapest Australian shares ETF is A200 from Betashares, with management fees of 0.04%. That's $4 a year on $10,000. Vanguard's VAS, the biggest ETF on the ASX at $22.6 billion, charges 0.07%. iShares IOZ sits in between at around 0.05%. Here's why this matters more than you think. Take $20,000, invested for 20 years at 8% growth. At A200's fee, you'd end up with roughly $90,500. That same money in a typical actively managed fund charging 1% finishes at about $79,500. That's an $11,000 gap from a fee difference you'd barely notice on your annual statement. Fees compound against you, just like returns compound for you. So what should you actually buy? You've got 2 paths, and the right one depends on how hands-on you want to be. The simplest option is a single all-in-one ETF that does everything in one trade. DHHF from Betashares gives you exposure to around 8,000 equity securities across Australian, developed and emerging markets. The fee is 0.19%, which Betashares says is the lowest fee amongst all-in-one diversified ETFs in Australia. Buy it, set up a regular investment, and don't think about it again. Vanguard's equivalent is VDHG with a fee of 0.27% and a 90-10 split between shares and bonds. Both pay quarterly distributions. One thing most people don't mention about VDHG though, because it's structured as a fund of funds that rebalances internally, that rebalancing can trigger capital gains that get passed through to you even when you haven't sold a single unit. It's not a deal breaker, but it makes VDHG slightly less tax efficient than holding the underlying funds yourself. If you want more control and slightly lower fees, the classic move is 2 ETFs, VAS for Australian shares and VGS for international. VGS tracks about 1,300 companies across 23 developed markets. The fee is 0.18% and it's sitting at roughly $14 billion in size. A typical split would be 40% VAS, 60% VGS. On $30,000, the 2 ETF approach costs about $41 a year in fees. DHHF on the same amount costs $57. The saving is modest, around $16 a year, but you control your own allocation and you avoid any internal rebalancing surprises. The trade-off is 2 buy orders each time, which means more brokerage unless you're on a free platform. Now here's where it gets interesting, because the tax side of ETFs is where beginners leave serious money on the table. When you sell ETF units for more than you paid, you owe tax on the capital gain. But if you hold for at least 12 months before the CGT event, you get a 50% discount, you only pay tax on half the gain. Say you're earning $70,000, which puts you in the 30% bracket. You sell and make a $5,000 gain. Held less than 12 months. $1,500 in tax. Wait one extra month past that 12-month mark and you pay $750. That's $750 saved for doing absolutely nothing. On a $10,000 gain, the saving doubles to $1,500. One more thing, if you make a loss instead, you can carry it forward to reduce capital gains in future years, so nothing is wasted. Australian share ETFs like VAS and A200 have another advantage that international ETFs don't: franking credits. When an Australian company pays 30% tax on its profits and distributes a dividend, you get a credit for the tax already paid. You receive $700 in cash plus a $300 franking credit, and you declare the full $1,000 as income. If your marginal rate is 30%, the tax on that $1,000 is $300, but the credit covers it net additional tax, $0. It gets better if you're on a lower income. Earning $35,000 puts you in the 16% bracket. Tax on the $1,000 is $160, but the franking credit is still $300. The ATO refunds you $140. You literally get money back. This is why Australian share ETFs are more tax efficient than international ones for people on lower incomes. But there's a rule you need to know. You must hold the shares at risk for at least 45 days to claim franking credits. Buy an Australian share ETF, collect a distribution within that window, and sell, you lose the credit entirely. One more thing that trips people up: ETF distributions go in the partnerships and trusts section of your tax return, not dividends. And if you're using a distribution reinvestment plan where your payouts automatically buy more units, that distribution is still taxable income in the year you receive it. Reinvesting does not defer tax. You'll also get annual cost-based adjustment statements. Keep those. If you don't apply the adjustments when you eventually sell, you could overpay capital gains tax by hundreds of dollars. If this is actually making ETFs click for you, hit subscribe. I break down one of these topics every week. The last decision is where to buy, and this one matters more than most people realize. If you're investing $1,000 a month through CompSec, that's $5 per trade, $60 a year. On stake, it's $3 brokerage on all trades up to $30,000, so $36 a year. CMC Invest offers free brokerage on buy orders up to $1,000 per stock per day. And Betashares Direct lets you invest in any ASX traded ETF with zero brokerage. On a $500 trade, CompSec's $5 fee is 1% of your money gone before you've earned a cent. But here's the trade-off: SEC, Stake, and CMC are all what's called CHESS sponsored. Your shares are registered directly in your name, which gives you direct ownership. Betashares Direct is custodial, meaning shares are held in the broker's name on your behalf. The upside of custodial is you can buy fractional shares and there's no minimum on your first purchase. On CHESS-sponsored platforms, the ASX requires a minimum first buy of $500 in any new holding. After that, top-ups can go as low as $20. CMC's free trades are limited to one buy per stock per day, up to 1,000, and sell orders still cost $11 or more. If CHESS sponsorship matters to you and you want a simple flat fee, stake at $3 is hard to beat. So if I was starting from zero today with a long time horizon, I'd go VAS and VGS on a low-cost CHESS-sponsored platform. The fees are rock bottom. I control my allocation, and the franking credits from VAS actually work in my favor at tax time. If rebalancing sounds like a chore and you just want one trade, DHHF does the job. 3 things to walk away with. First, fees compound against you. The gap between 0.04% and 1% is thousands of dollars over a couple of decades. Second, hold for at least 12 months before selling to halve your capital gains tax, and at least 45 days to keep your franking credits. Third, your platform choice matters most on small regular investments, so check whether you need CHESS sponsorship before you sign up. If this helped, smash the like button, subscribe, and let me know in the comments which ETF you're leaning toward. Check out one of these videos next. This is general information only, not personal financial advice. Please consider speaking with a licensed financial advisor before making any decisions.